Hello, and welcome to Finance 101, Understanding the Basics. Before we begin, it's important to state that the information provided in this series is for educational and informational purposes only. It is not intended to be a substitute for professional financial, investment, tax, or legal advice. Always seek the advice of a qualified professional with any questions you may have regarding your personal situation. So, let's start with the big question. What exactly is finance? You hear the word all the time, on the news and conversations, maybe even when you're just thinking about your own money. At its core, finance is simply the study and management of money. It's about how individuals, businesses, and governments acquire money, what we call capital, and how they spend or invest it. It's the art and science of making decisions about money. Now, you might be thinking, that sounds complicated. Is this really for me? The answer is a resounding yes. Personal finance is the bedrock of your financial well-being. It's about managing your own money to achieve your personal economic goals. Whether your goal is to buy a car, save for a down payment on a house, plan for retirement, or simply have enough money to handle an unexpected emergency, understanding the basics of finance is not just helpful, it's essential. Think of your financial life as a journey. You have a starting point, where you are today, and a destination, where you want to be in the future. Personal finance is the roadmap that helps you get there. It gives you the tools and the knowledge to navigate the path, avoid common pitfalls, and make smart choices along the way. Without this roadmap, it's easy to feel lost or overwhelmed. You might end up making decisions based on emotion or incomplete information, which can lead to stress and financial instability. One of the most fundamental concepts in personal finance is the budget. A budget is a plan for your money. It's a detailed breakdown of how much money you expect to earn and how you plan to spend it over a specific period, usually a month. Many people hear the word budget and think of restriction or sacrifice. They imagine having to give up everything they enjoy. But that's not what a budget is about. A budget is about empowerment. It's about telling your money where to go instead of wondering where it went. Creating a budget gives you a clear picture of your financial health. It shows you exactly where your money is going, and it helps you identify areas where you might be overspending. Once you have that information, you can make conscious decisions about your spending that align with your goals. Maybe you'll realize that your daily coffee habit is costing you over $100 a month, money that you could be putting towards your vacation fund. A budget doesn't mean you have to give up the coffee. It just means you are making an informed choice about it. Another key pillar of personal finance is saving. Saving is the act of setting aside a portion of your current income for future use. It's the engine that powers your financial goals. Without savings, it's nearly impossible to make significant financial progress. Financial experts often recommend the 50/30/20 rule as a simple starting point for budgeting and saving. Under this rule, you would allocate 50% of your after-tax income to your needs, things like housing, utilities, groceries, and transportation. 30% would go towards your wants, like dining out, entertainment, and hobbies. And the remaining 20% would be dedicated to savings and debt repayment. This is just a guideline, of course. Your personal percentages might look different based on your income, your expenses, and your goals. The important thing is to make saving a priority. One of the most effective ways to do this is to pay yourself first. This means that as soon as you receive your paycheck, you transfer a set amount of money into a separate savings account before you start paying bills or spending on other things. By automating your savings, you make it a consistent habit, and you're less likely to be tempted to spend that money elsewhere. Finally, let's touch on the concept of debt. Debt is money that you owe to someone else. Not all debt is created equal. There is good debt and bad debt. Good debt is typically money borrowed to purchase something that will increase in value or increase your earning potential. Examples could include a mortgage to buy a home or a student loan to get an education. Bad debt, on the other hand, is often used to purchase depreciating assets or for consumption. High-interest credit card debt is a classic example of bad debt. It can be incredibly difficult to pay off and can significantly hinder your ability to save and build wealth. Understanding the difference and learning how to manage debt effectively is crucial. High-interest debt can feel like running on a treadmill. You're putting in a lot of effort just to stay in the same place. Creating a plan to pay down high-interest debt is one of the most powerful steps you can take to improve your financial situation. To recap our first chapter, finance is the management of money. Personal finance is your roadmap to achieving your life goals. The core components of this roadmap are creating a budget to understand and control your spending, making saving a consistent habit to fund your future, and managing debt wisely to avoid financial roadblocks. By mastering these fundamentals, you are not just learning about numbers on a spreadsheet. You are building a foundation for a more secure and less stressful life. You are taking control of your future. Welcome back to Finance 101. As a reminder, this content is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. We strongly encourage you to consult with a qualified professional for advice tailored to your individual circumstances. In our last chapter, we introduced the concept of a budget as a roadmap for your financial journey. Today, we're going to build that map. The two most important landmarks on this map are your income and your expenses. Understanding these two elements is the first practical step toward taking control of your financial life. Let's start with income. Simply put, income is any money you receive. For most people, the primary source of income is a salary or wages from a job. This is often called active income because you are actively trading your time and labor for money. But there can be other sources too, like freelance work, tips, or money earned from a side business. It's also possible to have passive income, which is money earned from assets you own, such as rental income from a property or dividends from stocks. For now, let's focus on the money you have coming in on a regular basis. An important distinction to make is between gross income and net income. Your gross income is the total amount of money you earn before anything is taken out. Your net income, often called your take-home pay, is the amount of money you actually receive in your bank account after taxes, health insurance premiums, retirement contributions, and other deductions are subtracted. When you create your budget, you should always work with your net income, because that is the actual amount of money you have available to spend, save, and invest. Now let's turn to the other side of the equation, expenses. Expenses are everything you spend money on. To make sense of them, it's helpful to break them down into categories. The two main categories are fixed expenses and variable expenses. Fixed expenses are costs that generally stay the same from month to month. These are the predictable bills you have to pay regularly. Think of things like your rent or mortgage payment, car payments, student loan payments, and insurance premiums. Because they are consistent, they are usually the easiest to account for in your budget. Variable expenses, as the name suggests, are costs that change from month to month. These include things like groceries, gasoline for your car, utility bills, which can fluctuate based on the season, and household supplies. While they aren't the same every month, you can often estimate an average cost based on past spending. Within these categories, it's also useful to identify your discretionary expenses. These are your wants rather than your needs. This category includes things like dining out, entertainment, shopping for non-essential items, and hobbies. This is often the area where you have the most flexibility to make changes if you need to free up more money for your financial goals. So how do you put all this information together to create a budget? It's a straightforward process. Step 1 is to track everything. For one full month, your mission is to record every single dollar you earn and every single dollar you spend. Don't judge your spending yet, just observe and record. You can do this with a simple notebook and pen, a spreadsheet on your computer, or by using one of the many budgeting apps available today. Many banking apps also automatically categorize your spending, which can make this process even easier. The goal is to get an honest and accurate picture of where your money is actually going. You might be surprised by what you find. Step 2 is to analyze your results. At the end of the month, sit down and look at the data you've collected. Add up all your sources of income to get your total net income. Then add up all your expenses and categorize them. How much did you spend on needs like housing and food? How much went to wants like entertainment? And how much, if any, went towards savings or paying off extra debt? The simple formula is income, expenses equals surplus or deficit. If you have money left over, you have a surplus. If you spent more than you earned, you have a deficit. Step 3 is to create your plan. Now you can use this information to create a forward-looking budget. This is where you tell your money where to go. A great starting point is the 50/30/20 rule we mentioned in the last chapter. Allocate 50% of your net income to needs, 30% to wants, and 20% to savings and debt repayment. Remember, this is just a template. If your housing costs are high, your needs category might be larger. If you have aggressive debt payoff goals, you might allocate more than 20% to that category. The key is to create a plan that is realistic for you and your goals. This plan is your budget. The final and most important step is to review and adjust. A budget isn't a set-it-and-forget-it tool. It's a living document. Life changes. Your income might go up, or you might have a new expense. Plan to check in with your budget every week or at least once a month. See if you're staying on track. If you overspent in one area, see if you can cut back in another to compensate. The goal isn't perfection, it's progress and consciousness. Creating a budget isn't about restriction. It's about freedom. It's about giving you the clarity and control to use your money in a way that truly serves your best interests and helps you build the life you want. Hello and welcome back to Finance 101. We want to reiterate that the information shared in this series is for educational purposes only. It is not intended as a substitute for professional financial, investment, tax, or legal advice. Always consult a qualified professional for guidance specific to your personal situation. In our last session, we built a framework for understanding and tracking your money through budgeting. Now let's talk about the why. Why do we budget? Why do we track our expenses? The ultimate purpose is to free up money to achieve the things we want in life. And that is accomplished through saving. Saving is the engine that will drive you from where you are today to where you want to be tomorrow. The first and most critical savings goal for anyone should be establishing an emergency fund. An emergency fund is a stash of money set aside specifically to cover unexpected financial shocks. Think of it as your personal financial safety net. Life is unpredictable. A car can break down, a water heater can burst, or you could face an unexpected job loss. Without an emergency fund, these events can force you into high-interest debt, derailing your financial progress for years. How much should you have in an emergency fund? A common guideline suggested by many financial educators is to have enough money to cover 3 to 6 months of essential living expenses. Essential expenses include things like your rent or mortgage, utilities, food, transportation, and insurance, the absolute necessities. This money should be kept in a separate, easily accessible savings account. The key is liquidity. You need to be able to get to this money quickly and without penalty when an emergency strikes. It's not meant for investing or for planned purchases. It's for true, unforeseen emergencies only. Once you are on your way to building a healthy emergency fund, you can start focusing on other financial goals. It's helpful to categorize your goals by their timeline: short-term, mid-term, and long-term. Short-term goals are things you want to achieve in the next 1 to 3 years. This could be saving for a new laptop, planning a vacation, building a fund for holiday gifts, or paying off a small credit card balance. Midterm goals typically have a timeline of 3 to 10 years. These are larger objectives that require more significant savings, such as saving for a down payment on a house, buying a car, or planning for a wedding. Long-term goals are those that are more than 10 years away. The most common long-term goal is retirement. Other examples might include saving for a child's college education or paying off your mortgage early. Simply having goals isn't enough. You need to define them clearly. A powerful tool for this is the SMART goal framework. SMART stands for specific, measurable, achievable, relevant, and time-bound. Let's break that down. Specific. Your goal should be clear and well-defined. Instead of saying, "I want to save for a car," a specific goal would be, "I want to save for a down payment on a reliable used sedan." Measurable. You need to be able to track your progress. A measurable goal would be, "I want to save $5,000 for that down payment." Achievable. Your goal should be realistic given your financial situation. If you only have $50 a month to save, a goal of saving $20,000 in 1 year isn't achievable. It's important to set goals that challenge you but don't discourage you. Relevant. The goal should matter to you and align with your other objectives. Saving for a car you need for work is a relevant goal. Time-bound. Your goal needs a target date. This creates a sense of urgency. A time-bound goal would be, "I want to save $5,000 for a car down payment in 24 months. So the vague goal of saving for a car becomes a SMART goal. I will save $5,000 for a down payment on a used sedan by saving $209 per month for the next 24 months. See how much more powerful and actionable that is? You know exactly what you need to do. To reach these goals, the most effective strategy is to automate your savings. Treat your savings contribution like any other bill. Set up an automatic transfer from your checking account to your savings account every payday. This pay yourself first method ensures that you are consistently working toward your goals without having to rely on willpower alone. By creating an emergency fund and setting clear, actionable SMART goals, you transform saving from a chore into a purposeful act of building your future. Welcome back to Finance 101. Before we dive in, please remember that this content is for educational and informational purposes only. It is not financial, investment, tax, or legal advice. For guidance on your specific situation, we always recommend consulting with a qualified professional. Today we're tackling two of the most powerful and often misunderstood words in personal finance: debt and credit. Used wisely, they can be powerful tools to help you build wealth and achieve your goals. Managed poorly, they can become significant obstacles to your financial well-being. Our goal today is to demystify these concepts so you can use them to your advantage. Let's start with debt. As we touched on briefly in our first chapter, debt is simply money that you owe to another person or institution. A common mistake is to think that all debt is bad. In reality, it's more useful to think in terms of good debt versus bad debt. Good debt is typically money borrowed to purchase an asset that has the potential to grow in value or increase your income. The most common example is a mortgage. You borrow money to buy a home, which is an asset that, over the long term, is expected to appreciate in value. Student loans are another form of debt that can be considered good, as they are an investment in your education, which can significantly increase your earning potential throughout your career. Bad debt, on the other hand, is typically debt incurred to purchase depreciating assets or for consumption. A depreciating asset is something that loses value over time. The most classic example is high-interest credit card debt used for purchases like clothes, vacations, or dining out. The interest rates on this type of debt can be incredibly high, and the interest can compound against you, making it very difficult to pay off. Payday loans are another example of particularly high-cost debt to be aware of. Now let's talk about credit. Your credit is a measure of your ability to borrow money and repay it. Lenders use this to determine how risky it is to loan you money. This is all summarized in a simple 3-digit number: your credit score. Think of your credit score as your financial report card. Scores typically range from 300 to 850. The higher your score, the more trustworthy you appear to lenders. A high credit score can unlock lower interest rates on mortgages, car loans, and credit cards, potentially saving you thousands or even tens of thousands of dollars over your lifetime. It can even impact things you might not expect, like car insurance rates or the security deposit required to rent an apartment. This score is calculated based on information in your credit report. Your credit report is a detailed record of your history with credit. There are 3 major credit bureaus in the US that compile these reports: Equifax, Experian, and TransUnion. You are legally entitled to a free copy of your credit report from each of these bureaus once every year through a federally authorized website. Reviewing it is a great habit to get into, as it allows you to check for errors and understand your financial history. So, what factors influence your credit score? While the exact formulas are proprietary, they are generally based on 5 key areas. Payment history. This is the most important factor. It's a record of whether you have paid your bills on time. A history of late payments can significantly lower your score. Amounts owed. This looks at how much debt you carry, particularly on revolving credit like credit cards. A key metric here is your credit utilization ratio, the amount of credit you're using divided by your total credit limit. Generally, a lower utilization ratio is better for your score. Length of credit history. This considers the age of your oldest account and the average age of all your accounts. A longer history of responsible credit management is generally positive. Credit mix. This looks at the different types of credit you have, such as credit cards, a car loan, and a mortgage. Lenders like to see that you can responsibly manage various types of credit. New credit. This factor considers how many new accounts you have opened recently. Opening several new accounts in a short period can be seen as a sign of risk and may temporarily lower your score. Understanding these factors empowers you. You can build a positive credit history by consistently paying your bills on time, keeping your credit card balances low, and being thoughtful about opening new lines of credit. Building good credit is a marathon, not a sprint, and it starts with small, consistent, responsible actions. Hello, and welcome back to Finance 101. As we get started, we want to remind you that this material is for educational and informational purposes only. It is not intended to be a substitute for professional financial, investment, tax, or legal advice. Always seek the guidance of a qualified professional regarding your personal financial situation. So far, we've talked about budgeting, saving, and understanding credit. But where does all this money live? For most people, the answer is a bank or a credit union. Think of your bank as the central hub for your financial life. It's where your income arrives, where you pay your bills from, and where you store the money you're setting aside for your goals. Understanding the basic tools your bank offers is essential for effective day-to-day money management. First, it's helpful to know the difference between a bank and a credit union. Banks are for-profit institutions. Credit unions are not for-profit and are owned by their members. Because of this, credit unions may sometimes offer more favorable interest rates or lower fees, but banks might offer a wider range of services and more locations. Both are excellent options. The most important feature to look for is federal deposit insurance. At a bank, this is called FDIC insurance, and at a credit union, it's NCUA insurance. This insurance protects your money up to a certain amount, providing a critical layer of safety and peace of mind. The two most fundamental tools you will use are the checking account and the savings account. A checking account is your transactional account. It's designed for frequent use and is the primary tool for managing your daily cash flow. This is where your paycheck is likely deposited through direct deposit, and it's the account you'll use to pay your monthly bills, either through online bill pay or by writing checks. A checking account is linked to your debit card, which allows you to make purchases and withdraw cash from ATMs. Because this money is meant to be spent, checking accounts typically pay very little or no interest. It's important to be aware of potential fees, such as monthly maintenance fees or overdraft fees, which occur if you spend more money than you have in the account. A savings account, on the other hand, is designed for storing money you don't intend to spend immediately. This is the perfect home for your emergency fund and for the money you are setting aside for your short to mid-term goals. Unlike a checking account, a savings account pays you interest. The interest rate is a percentage of your balance that the bank pays you for keeping your money with them. This allows your savings to grow over time. A specific type you may hear about is a high-yield savings account. These accounts, often found at online banks, simply offer a significantly higher interest rate than traditional savings accounts. This means your money can grow faster, which is especially beneficial for goals like an emergency fund or a down payment for a house. Beyond these two primary accounts, there are other tools that may be useful. A certificate of deposit, or CD, is a type of savings account that holds a fixed amount of money for a fixed period of time, such as 6 months, 1 year, or 5 years. In exchange for you agreeing to leave the money untouched for that term, the bank typically offers a higher interest rate than a standard savings account. The trade-off is a lack of liquidity. Withdrawing the money early usually results in a penalty. Another option is a money market account, which can be thought of as a hybrid between a checking and a savings account. These accounts often pay a higher interest rate than traditional savings accounts and may come with check writing privileges or a debit card. However, they also frequently require a higher minimum balance to avoid fees, and may have limits on the number of withdrawals you can make per month. The key takeaway is to use the right tool for the right job. A checking account is for your everyday spending. A savings account is for your goals and your safety net. By understanding and utilizing these basic banking tools, you create an organized system that makes managing your money simpler, safer, and more effective. Welcome back to Finance 101. We must begin with an important reminder. The information provided here is for educational and informational purposes only, and is not investment, financial, tax, or legal advice. Investing involves risk, including the potential loss of principal. Before making any investment decisions, it is crucial to consult with a licensed financial professional who can provide advice tailored to your individual situation and risk tolerance. In our previous chapters, we focused on building a strong financial foundation, budgeting, saving for goals, and managing debt. Now we're going to introduce a new concept, investing. It's a word you've likely heard a lot, but what does it actually mean? The most important first step is to understand the fundamental difference between saving and investing. Saving is about preservation. You put money aside in a safe place, like an FDIC-insured savings account, for short-term goals and emergencies. The goal is to protect your principal, the initial amount you put in. Investing, on the other hand, is about growth. It involves using your money to purchase assets with the expectation that they will generate a return or increase in value over time. While saving protects your money from loss, investing aims to grow your money at a rate that outpaces inflation, which is the rate at which the cost of goods and services rises. This is how you build long-term wealth. This potential for greater growth comes with a critical trade-off: risk. When you invest, there is no guarantee that your assets will increase in value. In fact, their value could decrease, and you could end up with less money than you started with. This relationship between potential reward and risk is the central principle of investing. Generally, assets with the potential for higher returns also carry a higher level of risk. So why invest at all? The answer lies in the power of compounding. Compounding is the process where the earnings from your investments begin to generate their own earnings. It's like a snowball rolling downhill. Over a long period, the effect of compounding can be astonishing, allowing your initial investment to grow exponentially. This is why financial educators often say that time in the market is more important than timing the market. The earlier you start, the more time your money has to work for you. To understand investing, you need to know about the basic types of assets you can invest in. Let's define a few common ones. Stocks, also known as equities, represent a share of ownership in a public company. When you buy a stock, you become a part owner of that business. If the company does well and its profits grow, the value of your share may increase. Bonds are essentially loans. When you buy a bond, you are lending money to a corporation or a government entity. In return, they promise to pay you periodic interest payments over a set term, and then return your initial investment, the principal, at the end of that term. Bonds are generally considered to be less risky than stocks. Mutual funds and exchange-traded funds, ETFs, are collections of investments. Instead of buying just one stock or one bond, you can buy a share of a fund that holds dozens, hundreds, or even thousands of different stocks and bonds. This allows you to easily achieve diversification. Diversification is the practice of spreading your investments across various assets to reduce risk. It's the classic idea of not putting all your eggs in one basket. Investing is not about getting rich quick. It is a long-term strategy for patiently building wealth. It requires a different mindset than saving. While you need to access your savings for emergencies, investment funds are typically meant to be left alone for many years, allowing them to ride out the inevitable ups and downs of the market. Welcome back to Finance 101. As we discuss retirement accounts, it's essential to state that this is for educational purposes only and does not constitute financial, legal, or tax advice. The rules surrounding these accounts can be complex and are subject to change. For decisions regarding your personal retirement strategy, consulting with a qualified financial advisor and a tax professional is highly recommended. In our last chapter, we introduced the concept of investing for long-term growth. Now let's talk about the most common tools Americans use for this purpose: retirement accounts. These are not investments themselves, but rather special types of accounts that hold your investments. Their power comes from the significant tax advantages they offer, which are designed by the government to encourage people to save for the long term. The first type, which you will likely encounter through your job, is an employer-sponsored plan, the most common of which is the 401k. A 401k is a retirement savings plan that allows you to contribute a portion of your paycheck directly into an investment account. One of the key features of a 401k is how it's taxed. Many plans offer two options: a traditional 401k and a Roth 401k. With a traditional 401k, you contribute money before it gets taxed. This lowers your taxable income for the current year, which means you pay less in taxes today. Your investments then grow tax-deferred, meaning you don't pay taxes on the growth year after year. The taxes are paid later, when you withdraw the money in retirement. With a Roth 401k, the process is reversed. You contribute money after it has been taxed. This means you don't get an upfront tax break. However, your investments still grow tax-deferred, and the major benefit is that your qualified withdrawals in retirement are completely tax-free. Perhaps the most powerful feature of a 401k is the employer match. Many companies will offer to match your contributions up to a certain percentage of your salary. For example, a common match is 100% of the first 3%. This means if you contribute 3% of your salary, your employer will contribute an additional 3% on your behalf. This is essentially a 100% return on your investment, and is a benefit you should understand fully. Be aware of your company's vesting schedule, which dictates how long you must work there before the matching funds are truly yours to keep. What if you don't have a 401k at work, or you want to save more? This is where an individual retirement account, or IRA, comes in. An IRA is a retirement account that you can open and fund on your own at most brokerage firms or banks. Like the 401k, IRAs come in two main varieties: traditional and Roth. A traditional IRA works similarly to a traditional 401k. Your contributions may be tax-deductible, which lowers your taxable income for the year. The money then grows tax-deferred, and you pay income tax on withdrawals in retirement. A Roth IRA works like a Roth 401k. You contribute with after-tax dollars, meaning no upfront deduction, but your investments grow completely tax-free, and your qualified withdrawals in retirement are also tax-free. It's important to note that the ability to contribute to a Roth IRA is subject to income limitations set by the IRS. Both 401k.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
S&I IRAs have annual contribution limits, which are set by the IRS and can change from year to year. These accounts are designed for the long haul. Withdrawing money before a certain age, typically 59.5, can result in taxes and penalties. By offering these powerful tax advantages, these accounts provide a dedicated and effective way to build wealth for your future. Hello and welcome back to Finance 101. We must begin with our important reminder. This material is for educational purposes only and is not investment advice. The concepts discussed are general principles. An individual's investment strategy should be determined after consulting with a qualified financial professional who understands their specific goals, timeline, and tolerance for risk. In our last few chapters, we've identified what investing is and the types of accounts you can use. Now we'll discuss the strategy of how to combine different investments within those accounts. This is where we introduce two of the most important concepts in investing: diversification and asset allocation. We've touched on diversification before with the phrase, "Don't put all your eggs in one basket." But let's go deeper. The goal of diversification is to manage risk. Different types of investments, or assets, often behave differently under the same economic conditions. When one is performing poorly, another might be performing well. By owning a mix of different assets, you spread out your risk. A loss in one area of your portfolio can potentially be offset by gains in another, leading to a smoother overall investment experience. This leads directly to the core strategy of asset allocation. Asset allocation is the process of deciding how to divide your portfolio among major asset categories. For most people, this means a mix of stocks, bonds, and cash or cash equivalents. Many financial professionals consider your asset allocation decision to be the single most important factor in determining your long-term investment returns. Let's quickly review the roles these asset classes typically play in a portfolio. Stocks are generally the primary engine for growth. They have the highest potential for long-term returns, but they also come with the highest volatility and risk. Bonds are typically included to provide stability and income. Their returns are usually lower than stocks, but they are also generally less volatile. They can act as a cushion when the stock market is declining. Cash and cash equivalents, like a money market fund, are the safest part of a portfolio. They provide stability and are readily available, but they offer very little potential for growth and can lose purchasing power over time due to inflation. So how do you decide on a mix? There is no single correct answer, as the ideal asset allocation is deeply personal. However, it's generally guided by two key factors: your time horizon and your risk tolerance. Your time horizon is the length of time you have until you need to use the money. If you are in your 20s and saving for retirement, you have a very long time horizon, several decades. This long timeline gives your portfolio ample time to recover from any market downturns. Therefore, you may be able to take on more risk in pursuit of higher growth, which often means a higher allocation to stocks. Conversely, someone who plans to retire in 5 years has a very short time horizon and less time to recover from losses. They would likely choose a more conservative allocation with a higher percentage in bonds and cash to preserve their capital. Your risk tolerance is your personal comfort level with market fluctuations. It's about your emotional and financial ability to handle seeing your portfolio's value go down without panicking. Some people are comfortable with aggressive strategies, while others prefer a slow and steady approach. Understanding your own temperament is a crucial part of building a strategy you can stick with for the long run. Based on these factors, asset allocation models are often described in general terms. For example, an aggressive allocation might be heavily weighted in stocks. A conservative allocation would have a much higher percentage in bonds. And a moderate or balanced allocation would fall somewhere in the middle. The key is to create a mix that aligns with your specific goals and allows you to sleep at night, confident in your long-term plan. Hello, and welcome back to Finance 101. We must emphasize again that this content is for educational purposes and should not be considered investment advice. Long-term investing involves navigating market changes, and the principles discussed here are general concepts. A qualified financial professional can provide guidance on how these concepts apply to your personal situation. In our last chapter, we discussed the importance of building a portfolio with a specific asset allocation that matches your goals and risk tolerance. But building a portfolio is just the first step. The next, and equally important, part is maintaining it over the long term. This involves two key disciplines: rebalancing, and perhaps most importantly, staying the course. First, let's talk about rebalancing. Over time, as markets move, your portfolio's original asset allocation will naturally drift. Let's imagine you started with a target allocation of 60% stocks and 40% bonds. If stocks have a particularly strong year, their value might grow faster than your bonds. After a year, your portfolio might have drifted to be 70% stocks and 30% bonds. While it feels good that your investments have grown, your portfolio is now carrying more risk than you originally intended. It has become more aggressive. Rebalancing is the simple act of periodically buying or selling assets to return your portfolio to its original target allocation. In the example above, you would sell some stocks and buy some bonds to get back to your 60-40 mix. This process has a powerful, built-in discipline. It forces you to systematically sell high and buy low. You are trimming the asset class that has performed well, and is now a larger part of your portfolio, and you are buying more of the asset class that has underperformed. This might feel counterintuitive, but it's a key strategy for managing risk and sticking to your long-term plan. There are different approaches to rebalancing. Some people do it based on time, reviewing their portfolio once a year on their birthday, for example. Others do it based on a threshold, rebalancing only when an asset class drifts by a certain percentage, like 5% from its original target. There is no single correct way. The important thing is to have a plan and execute it consistently. This leads us to the second, and arguably more challenging, aspect of portfolio maintenance: the psychological discipline to stay the course. Financial markets do not move in a straight line. They go up, and they go down. During periods of market decline, it is a natural human instinct to feel fear, and want to sell your investments to avoid further losses. During periods of rapid growth, it's easy to feel greedy and want to chase the hottest trends. Acting on these emotions is often the biggest mistake an investor can make. Your financial plan and asset allocation were designed with the knowledge that markets fluctuate. Selling in a panic locks in your losses, and often means you are on the sidelines when the market eventually recovers. Chasing hot stocks can lead to buying at the peak, just before a downturn. Successful long-term investing is often more about managing your behavior than it is about picking the perfect stocks. It's about having the conviction to stick with your well-thought-out plan through both good times and bad. This means tuning out the daily news headlines and focusing on your long-term goals. It means remembering that volatility is a normal part of the investing process, not a sign that your plan has failed. Discipline and patience are an investor's greatest allies. Hello, and welcome back to Finance 101. As we discuss insurance, please remember that this information is for educational purposes only. It is not advice or a recommendation to purchase any specific product. The world of insurance is complex, and for guidance on your individual needs, it is best to speak with a licensed insurance professional. So far, our journey has focused on building wealth through budgeting, saving, and investing. Now we're going to shift our focus to protecting that wealth. A solid financial plan isn't just about growth. It's also about building a safety net to handle life's unexpected events. This is the fundamental role of insurance. At its core, insurance is a tool for risk management. You pay a regular, predictable amount of money, called a premium, to an insurance company. In exchange, the company agrees to take on the financial risk of a specific, often very large and unpredictable loss. This transfer of risk protects your savings, your investments, and your family from a catastrophic financial blow that could otherwise derail your future. Let's explore some of the most common types of insurance and the roles they play. First is health insurance. In the United States, where healthcare costs can be extraordinarily high, health insurance is a critical component of financial security. It is designed to cover the costs of medical and surgical expenses. Without it, a single accident or serious illness could lead to overwhelming debt. Understanding terms like your deductible, the amount you pay before insurance kicks in, and your copay, a fixed amount for a service, is key to using your plan effectively. Next is auto insurance. If you own and drive a car, auto insurance is not just a good idea. In most states, it is legally required. Its primary purpose is to provide liability coverage, which pays for damages to other people's property or for their injuries if you are at fault in an accident. It can also cover the cost of repairs to your own vehicle. Similarly, there is homeowners and renters insurance. If you own a home, homeowners insurance protects the structure of your house and your personal belongings from events like fire, storms, or theft. If you rent, renters insurance covers your personal property inside the apartment. Both types of policies also include vital liability protection in case someone is injured on your property. Another key type is life insurance. The purpose of life insurance is to provide financial support to your designated beneficiaries after you pass away. If you have anyone who depends on your income, like a spouse or children, life insurance is a tool to ensure they can cover living expenses, pay off debts, and maintain their financial stability. The two most common forms are term life insurance, which covers you for a specific period, and permanent life insurance, which is designed to last a lifetime. Finally, there's disability insurance. Many people call this paycheck insurance. While life insurance protects your family if you're no longer there, disability insurance protects you and your family if an injury or illness prevents you from working and earning an income for an extended period. It replaces a portion of your lost income, allowing you to continue paying your bills and funding your goals while you recover. Think of insurance as the foundation of your financial house. It's the sturdy base that allows your investments and savings to grow, secure in the knowledge that one of life's unexpected storms won't wash it all away. Hello and welcome back to Finance 101. We are now going to discuss a topic that impacts every aspect of your financial life: taxes. Before we proceed, it is critical to understand that this chapter is for informational and educational purposes only. It is not tax advice. Tax laws are complex and change frequently. For any questions or guidance regarding your personal tax situation, you must consult with a qualified tax professional. Taxes can feel intimidating, but understanding the basic structure of the system is the first step toward managing them with confidence. In the United States, the federal income tax system is progressive. This means that as a person's income increases, they pay a higher percentage of their income in taxes. The system is built on different tax brackets, so higher portions of your income are taxed at progressively higher rates. Let's walk through a few key terms to understand how your tax bill is calculated. It all starts with your gross income. This is all the money you receive during the year from all sources: your salary, freelance income, investment returns, and more. From there, certain specific expenses can be subtracted to arrive at your adjusted gross income, or AGI. The AGI is a very important number on your tax return, as it's used to determine your eligibility for various deductions and credits. Next, you lower your income even further with deductions. A deduction is an amount that the IRS allows you to subtract from your AGI to reduce the amount of income that is subject to tax. You have two choices here. You can take the standard deduction, which is a fixed dollar amount that any taxpayer can claim. Or if you have enough eligible expenses, you can itemize deductions. This involves adding up specific costs, such as mortgage interest, state and local taxes, and charitable contributions. You would choose whichever method, standard or itemized, results in a larger deduction. After subtracting your deductions from your AGI, you are left with your taxable income. This is the final amount of money that your tax is actually calculated on. Once your initial tax is calculated, you may be able to lower it with tax credits. Tax credits are very powerful. While a deduction reduces your taxable income, a credit provides a dollar-for-dollar reduction of your final tax bill. For example, a $1,000 tax credit reduces the amount of tax you owe by the full $1,000. Finally, we have the process of withholding and filing. For most employees, your employer withholds an estimated amount of tax from each paycheck and sends it directly to the government. When you file your tax return each year, you are reconciling everything. You calculate what you actually owe based on your income, deductions, and credits, and compare that to what was already withheld. If too much was withheld, you get a refund. If not enough was withheld, you will owe an additional payment. While the details can be complex, the basic flow is straightforward. You determine your income, reduce it with deductions, calculate the tax, and then subtract any credits. Understanding this vocabulary is the foundation for navigating your own financial responsibilities. Hello, and welcome back to Finance 101. Today we are focusing on a major financial goal for many American families: saving for education. The information provided is for educational purposes only, and is not tax or investment advice. The rules for education savings accounts can be complex, so consulting with a qualified financial or tax professional for personalized guidance is always recommended. The cost of higher education can be one of the largest expenses a family will face. Planning and saving for it well in advance can make a significant difference. Just like with retirement, the government has created tax-advantaged accounts specifically designed to encourage people to save for education expenses. Using these accounts can provide a powerful boost to your savings efforts. The most popular and widely used of these is the 529 plan. A 529 plan is an investment account that offers significant tax benefits when the money is used for qualified education expenses. These plans are sponsored by individual states, but you are typically not restricted to using your own state's plan. The primary advantages of a 529 plan are tax-related. First, the money you contribute is invested and can grow tax-deferred. This means you don't pay taxes on the investment earnings each year. Second, and most importantly, withdrawals are completely tax-free at the federal level when used for qualified education expenses. These expenses generally include tuition, fees, books, supplies, and room and board at eligible colleges, universities, and vocational schools. Many states also offer a state income tax deduction or credit for contributions made to their specific plan. A 529 account has an owner, typically a parent or grandparent, and a beneficiary, who is the student. The owner maintains control over the account, including the investment decisions and withdrawals. If the original beneficiary decides not to pursue higher education, the owner can typically change the beneficiary to another eligible family member. Another tool for education savings is the Coverdell Education Savings Account, or ESA. A Coverdell ESA is similar to a 529 plan in that it offers tax-deferred growth and tax-free withdrawals for qualified education expenses. However, there are a few key differences. Coverdell ESAs can be used for a broader range of K-12 expenses, not just tuition. They may also offer more flexibility in investment choices, allowing you to invest in individual stocks and other securities. The trade-offs are that Coverdell ESAs have much lower annual contribution limits compared to 529 plans, and there are income restrictions for individuals who want to contribute. The most important takeaway is that starting early and saving consistently are key to meeting any large savings goal. The power of compounding growth, especially within a tax-advantaged account like a 529 plan, can be a tremendous ally in the journey to fund a future education. Hello, and welcome back to Finance 101. Today we're discussing one of the biggest financial milestones in many people's lives: homeownership. Please remember, this is an educational overview, not financial or real estate advice. Buying a home is a major decision with many personal and financial variables, and we recommend consulting with qualified professionals like mortgage lenders and real estate agents. For most people, the path to homeownership is the largest financial undertaking of their lives. It's more than just a purchase, it's a long-term commitment. Understanding the key steps can make the process less intimidating. The first major financial hurdle is the down payment. This is the portion of the home's purchase price that you pay up front out of your own savings. A common benchmark you'll hear is a 20% down payment. The primary reason for this guideline is to avoid private mortgage insurance, or PMI. PMI is a type of insurance that protects the lender, not you, in case you are unable to make your mortgage payments. Lenders typically require PMI on conventional loans when the down payment is less than 20%. While there are loan programs that allow for lower down payments, understanding the 20% threshold and PMI is a key piece of the financial puzzle. The next step is securing the financing for the rest of the purchase price, which is done through a mortgage. A mortgage is a long-term loan from a bank or other lender used to buy real estate. Before you even start looking at houses, it's a good practice to get pre-qualified or pre-approved for a mortgage. This process involves a lender reviewing your finances to determine how much money you can likely borrow, which helps you set a realistic budget for your home search. There are two primary types of mortgages. A fixed-rate mortgage has an interest rate that is locked in and does not change for the entire term of the loan, providing a predictable monthly payment. An adjustable-rate mortgage, or ARM, has an interest rate that can change periodically after an initial fixed period, meaning your monthly payment could go up or down. When you think about your monthly housing cost, it's important to look beyond just the loan repayment. A typical mortgage payment is often referred to by the acronym PITI, which stands for Principal, Interest, Taxes, and Insurance. Principal is the portion of your payment that goes toward paying down the original loan balance. Interest is the cost of borrowing the money. Taxes refers to the property taxes you'll pay to your local government. Insurance is your homeowner's insurance premium. Lenders often collect the tax and insurance portions in an escrow account and pay them on your behalf. Finally, it's crucial to be aware of the other costs of homeownership. At the time of purchase, you will have closing costs, which are fees for services required to complete the real estate transaction, such as the appraisal, title search, and loan origination fees. And once you own the home, you are responsible for all maintenance and repairs, costs that renters do not have. Planning for these ongoing expenses is a vital part of a sustainable homeownership budget. Hello, and welcome back to Finance 101. Today we're going to discuss a topic that is a crucial, yet often overlooked, part of a comprehensive financial plan: estate planning. It is imperative to state that this information is for educational purposes only and is not legal or financial advice. Estate planning involves creating legal documents, and you must consult with a qualified attorney to create a plan that is valid and meets your specific needs. What is estate planning? Simply put, it's the process of deciding how your assets will be managed and distributed after you pass away. This is not a topic reserved for the wealthy. Anyone who has assets and cares about what happens to them should have a basic plan in place. It's an act of organization and a final gift of clarity you can leave for your loved ones. The cornerstone of most estate plans is the last will and testament, commonly known as a will. A will is a legal document that clearly states your wishes. Its primary functions are to specify how you want your property to be distributed, and to name a guardian for any minor children you may have. In your will, you also name an executor. This is the person or institution you trust to be in charge of carrying out your will's instructions, such as paying off any final debts and distributing your assets to the people you have named. If you pass away without a will, you are said to have died intestate. In this situation, the laws of your state will determine how your property is divided. A court will appoint an administrator, and your assets will be distributed according to a predetermined legal formula. This process can be slow, public, and costly, and the outcome may be very different from what you would have wanted. While a will is essential, it's crucial to understand that it does not control everything. This brings us to our next key concept: beneficiary designations. A beneficiary is the person or entity you name to directly receive the assets from a specific account, such as a life insurance policy, a 401k, an IRA, or other investment accounts. Beneficiary designations are incredibly powerful. In nearly all cases, the beneficiary designation on an account supersedes what is written in your will. For example, if your will states that all your assets should go to your spouse, but your 401k from an old job still lists a parent as the beneficiary, that 401k will go to your parent. The will has no power over it. This is why it is vital to periodically review and update the beneficiaries on all of your accounts. Major life events, like a marriage, divorce, the birth of a child, or the death of a named beneficiary, should always trigger a review to ensure your designations align with your current wishes. By creating a will and keeping your beneficiaries updated, you create a clear roadmap for your loved ones, minimizing confusion, potential legal conflicts, and stress during an already difficult time. Hello, and welcome to the final chapter of Finance 101. Before we conclude, we want to offer one final, crucial reminder. This entire series has been for educational and informational purposes only. It is not, and has never been, a substitute for personalized financial, investment, tax, or legal advice. Your financial journey is unique, and we strongly encourage you to consult with qualified professionals to build a plan that is right for you. We have covered a tremendous amount of ground together. We started with the very basics, defining what finance is and why it matters. We built a foundation by learning how to create a budget, track our income and expenses, and tell our money where to go. We demystified the world of debt and credit, transforming them from sources of stress into tools you can understand and manage. From there, we explored the pillars of building a secure future. We talked about the critical importance of saving, setting smart goals, and establishing an emergency fund to act as your financial safety net. We distinguished saving from investing and introduced the foundational concepts of stocks, bonds, and funds. We then explored the powerful, tax-advantaged accounts like 401k, and IRAs that are designed to help you save for long-term goals like retirement. Finally, we covered the essential topics of protecting your progress through insurance and providing for your loved ones through basic estate planning. From budgeting to beneficiaries, you now have a foundational vocabulary and a conceptual map of the world of personal finance. The most important takeaway from this entire series is that personal finance is not a topic to be mastered and then forgotten. It is a lifelong journey. Your life will change, your income will fluctuate, your goals will evolve, your family will grow. Your financial plan must be a living, breathing document that adapts along with you. Your goal should not be to know everything, but to commit to being a continuous learner. Stay curious. Read books on personal finance. Follow reputable sources for financial news and education. The more you learn, the more confident you will become in your decisions. You now possess the foundational knowledge to take meaningful action. You understand the why behind managing your money. Whether your next step is to create your very first budget, to finally set up that automatic transfer to your savings account, or to seek out a qualified professional to guide you, you are prepared to take it. The path to financial well-being is not about getting rich quick, and it's not about perfection. It's about progress. It's about making conscious, informed decisions one step at a time. It's about building a life that is less about financial stress and more about financial security and freedom. Thank you for joining us on this journey through Finance 101. We wish you the very best as you take these concepts and apply them to build your own, unique, and successful financial future.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.